And Dom, on the January 3rd episode of Investing Insights, we talked about the fixed income opportunities that really existed outside the US. What's the mid-year update?
Yeah, I think when we had that conversation, one of the things we liked was emerging market debt. Obviously higher yielding than the US because it's lower quality and higher volatility. That differential between those two has actually compressed. So if you had owned emerging market debt, you would have outperformed US Treasury debt. Today, that compensation spread is not as appealing as it was 6 months ago. So perhaps not as appealing, but we still think it's close to offering some value to investors. What's really happened more than yields moving up has been the shape of the yield curves have changed globally. So going back to beginning of this year and certainly in 2024, many global yield curves were inverted, meaning that short end yields were higher than longer end yields, which is an abnormal situation to be in. That has really normalized across the globe to be more like historical long-term averages where short-term yields are less than long-term yields. So it's really been a function of changes in the shape of the yield curve. And we've done a lot of work to try and examine the best way to take advantage of that. And our team really thinks that being concentrated in the middle of the maturity range, kind of that 5 to 10 year maturity range, is kind of the optimal exposure right now.